Hey everyone, if you've ever wanted to invest in the stock market but felt lost with all the confusing terms, you're not alone. Words like bull market, dividends, and PE ratio might sound intimidating, but understanding them is easier than you think. In this video, I'm going to break down the most important stock market terms you need to know as a beginner. Stock/share. Let's start with the basics. A stock or share represents a small ownership in a company. When you buy a share, you own a piece of that company. Companies issue shares to raise money for growth, and in return, shareholders can earn money through dividends and stock price increases. For example, if you buy 10 shares of Apple, you own a tiny part of the company. If Apple grows, the value of your shares can go up. But if the company faces losses, the value of your shares can go down. Stock exchange. A stock exchange is where stocks are bought and sold. Think of it like a giant marketplace, but instead of fruits and clothes, people trade company shares. The most famous stock exchanges in the world are the New York Stock Exchange, NYSE, and NASDAQ. In Pakistan, the main stock exchange is the Pakistan Stock Exchange, PSX. Companies get listed on these exchanges to make it easier for investors to buy and sell their shares. Bull market and bear market. You've probably heard people say the market is bullish or bearish. A bull market happens when stock prices are rising or expected to rise. Investors feel confident and want to buy more shares. On the other hand, a bear market happens when prices are falling or expected to fall. Investors may become cautious and sell shares to avoid losses. Understanding these terms helps you know the general trend of the market. A dividend is a portion of a company's profits that is paid to shareholders. Not all companies pay dividends, but some choose to share profits regularly. For example, if a company announces a $1 dividend per share and you own 100 shares, you'll get $100 as dividend income. Dividends are a way to earn passive income while holding stocks. Companies like Coca-Cola and Microsoft are known for paying consistent dividends. Market capitalization, market cap. Market capitalization, or market cap, is the total value of a company's shares. It's calculated by multiplying the number of shares by the current stock price. For example, if a company has 1 million shares and the current price is $50 per share, the market cap is $50 million. Market cap helps investors understand the size of a company. Companies are usually classified as large cap, over $10 billion, mid cap, $2 billion to $10 billion, small cap, under $2 billion, P/E ratio, price to earnings ratio. The P/E ratio is a way to see if a stock is expensive or cheap compared to its earnings. It's calculated by dividing the stock price by the company's earnings per share, EPS. For example, if a stock costs $100 and the company earns $5 per share, the PE ratio is 20. A high PE might mean investors expect high growth, but it could also mean the stock is overvalued. A low PE could mean the stock is undervalued or the company is struggling. IPO, initial public offering. An IPO is when a private company sells its shares to the public for the first time. Companies go public to raise money for growth or expansion. Investing in IPOs can be exciting because early investors might see big returns. But IPOs are also risky because the company is new to the public market and its stock price can fluctuate a lot. ETF, Exchange Traded Fund. An ETF is like a basket of stocks that you can buy as a single investment. Instead of buying individual shares, you invest in multiple companies at once. For example, a technology ETF may include Apple, Microsoft, and Google in one fund. ETFs are great for beginners because they provide diversification, which reduces risk. They also trade on stock exchanges, just like regular stocks. Broker/brokerage account. To buy and sell stocks, you need a broker or a brokerage account. Brokers are platforms or companies that allow you to trade stocks. There are traditional brokers and online brokers. When choosing a broker, consider fees, ease of use, and reliability. Volatility. Volatility measures how much a stock price moves up or down over time. High volatility means the stock can change price quickly, which can be risky but also offers opportunities. Low volatility means the stock price moves slowly, which is safer but may give smaller returns. Understanding volatility helps you choose stocks that match your risk tolerance. Blue chip stocks. Blue chip stocks are shares of well-established companies with a history of stability and reliable growth. Examples include Apple, Microsoft, and Johnson & Johnson. These stocks are considered safer investments and are often preferred by beginners or conservative investors. They may not grow as fast as small-cap stocks, but they provide stability and steady returns. Portfolio diversification. Diversification means spreading your investments across different stocks or asset types to reduce risk. For example, instead of investing all your money in one company, you can invest in technology, healthcare, and energy stocks. This way, if one sector underperforms, the others may balance out your losses. Diversification is one of the key principles of smart investing. So there you have it, a beginner's guide to the most important stock market terms. From stocks and dividends to ETFs and PE ratios, these are the words every new investor should understand. The stock market can seem complicated at first, but once you learn these basics, it becomes much easier to make informed decisions. Remember, investing is a journey, not a sprint. Start small, keep learning, and gradually build your knowledge and portfolio. If you found this video helpful, hit the like button, subscribe for more beginner-friendly investing guides, and don't forget to share this with a friend who wants to start investing. Thanks for watching, and happy investing.